We are back, baby. The whole team here, 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, markets are waiting for signs of what's next from the Fed. After the last big rate cut, we're going to get PMI data today at 9:45.
Meanwhile, stimulus hopes rise as China announces plans for a rare briefing on the economy and cuts one of its short-term policy rates.
Plus, Intel interest. Apollo is said to have offered a multi-billion-dollar investment in the chip maker just days after rival Qualcomm reportedly floated a friendly takeover. That is friendly. Let's take a look at where markets are trading about 30 minutes until we hear those bells ring. You can see there's green on the screen behind me. Of course, we're coming off of 2 straight weeks of big gains. The S&P 500 currently up modestly, about 0.2%, a little bit more if you take a look at big tech. The Nasdaq 100 up about 0.3%. The bond market pretty calm right now. You have yields up a little bit when you take a look at that benchmark 10-year yield. We're only talking about 3 basis points, Matt, as we really wait for what the next catalyst is.
All right, speaking of treasuries, we're looking at a steepening curve here. It's disinverted, and this could be encouraged even further if we get PMIs. In Europe, they got a disappointment on PMIs. That encouraged a bull steepening, which is, correct me if I'm wrong, you're buying in the front end, and that pushes those yields down. And in any case, we'll get to that.
We will, but 16 basis points to your point of a differential is pretty interesting. Haven't seen it in a while. Some stocks to watch, though, outside of the bond market. Of course, Intel rising on news that Apollo offering up to $5 billion in an equity-like investment, according to sources. Qualcomm has also recently approached Intel about a friendly takeover, though it's unclear whether that initial discussion will lead to a deal, according to sources. You have Intel shares up pre-market about 1.5%. It was up a little more earlier. We'll keep an eye on that. Palantir also down about 1.3% pre-market, under pressure after Raymond James downgraded the stock, which enters the S&P 500 today. Also watching Dell, also entering the S&P 500, but shares unchanged, Matt.
All right. First of all, I couldn't have delivered that China headline with any less enthusiasm, but it could be a massive story if China finally unleashes the stimulus that markets have been calling for years. And then the Intel story.
Yeah.
Friday night, when this headline came out, scoop from the Wall Street Journal that Qualcomm approached them for a friendly takeover. It was huge.
It was huge. And I mean, I was gone last week. I don't know if you guys noticed, but when I left, Intel was like bottom of the barrel. Everyone was doom and gloom. I come back, the stock rallied 11% last week. And now it seems like everyone wants a piece of it, from, of course, Apollo to Qualcomm. Everyone wants Intel right now.
A little bit of competition is good here, because we had reported not only is Qualcomm taking a look here, Broadcom is not. So that Apollo competition here with a potentially multi-billion-dollar investment adds some steam to the story here, and potentially some competition in terms of who gets to invest.
It really needed some steam, some positive steam, because there was a lot of negative news surrounding Intel, clouds of it, for a couple of years. Let's dig into the situation at Intel. Bloomberg Technology co-host Ed Ludlow joins us. And Ed, you know, I talked to you on Friday night after the Qualcomm story broke. Now Apollo wants to invest possibly $5 billion. This is a business that, you know, by the market's judgment was a failing one, right? Down 60% year to date. And now it seems like everybody wants a piece. Why?
Yeah, I mean, the Apollo development is less surprising than the Qualcomm approach was on Friday. The latest, according to sources, is that Apollo would make an equity investment in Intel. One source said it would be about $5 billion. So that's the kind of scale we're talking about. And they have some history, right? They've co-invested strategically on fab capacity in Ireland. But it kind of speaks to the idea that even though Intel has a new strategy, it announced this rethink just 1 week ago on its path forward, that strategy is still dependent on capital. And Apollo would be an interesting source of finding the cash.
Well, Ed, talk to me a little bit more about that turnaround plan. Again, I was in vacation on the mountains, but paying attention a little bit. Of course, we got more details about what Pat Gelsinger and, of course, Intel is planning to do here to reverse the ship. But talk to us more about what the path forward looks like and how an Apollo would play into that strategy.
Yeah, Intel has two parts to its business. It designs semiconductors for specific functions, chips that go into PCs, data centers, and then it also manufactures them. We talk a lot about chip makers on this program, but a lot of the names that we discuss are not actually chip makers. They design them and hand them off to a third party. For Intel, about 70% of their revenues is products, and those products are not competitive right now. They're struggling. And the foundry part of their business is where they see their potential, but it's where they have the widest losses. Sales have been declining for about 3 straight years, and losses have been widening in the business of manufacturing semiconductors, principally for their biggest customer, which is themselves, but also other third parties. To make that competitive, you need scale. And scale means putting money into new fabs. Some of that comes from the CHIPS Act. But central to Pat Gelsinger's strategy, which he calls smart capital, is money from the balance sheet, money from the public sector, and then money from what he's always called strategic investors. And Apollo fits that bill.
Well, to that end also, there's been other news around Intel, despite the conversation around potential mergers, acquisitions, divestitures, and that is their potential investment from the U.S. government for as much as $3 billion for chips for the military. That is their conversations with Amazon as well. How does this other interest and other investment around its own products really add to the story?
The mechanics of how companies access the CHIPS Act money is really important. Basically, you don't just get the money up front. You have to go out and build something and prove that the money awarded through the CHIPS Act will find a home in the end. But the defense component's interesting because Intel won a big contract for basically defense-related semiconductors that many other domestic US names have more experience in doing than Intel has. So that's a really important component. But manufacturing semiconductors is not simple. Just to build the building, let alone put the machinery inside it, is a many multi-year process. You don't just do it overnight. And as you guys know, semiconductors are largely cyclical, even if they're in sexy markets like data centers. So by the time you've built all this capacity, there's no guarantee that the demand you had the moment you put your shovel in the ground is still there once the thing's up and humming. And that's a problem for Intel because you have to keep your investor base patient. And the whole point of this rethink that Intel's going through, the attraction from Apollo for more investment, Qualcomm eyeing an acquisition, which I can't believe I'm saying out loud, it's all very interesting timing because they're going through the macro events of the industry as well.
Bloomberg technology co-host Ed Ludlow, we're looking forward to your coverage later today. We thank you so very much for your time. There's plenty of other semiconductor news, including a report that TSMC and Samsung are considering chip plants in Saudi Arabia and an agreement between the United States and India to build, UAE, to build a chip factory also in India. So between the UAE and India, we definitely have a lot of international interest in where really chips are manufactured and the global industry coming together to fuel these companies. Let's discuss all of this with Bloomberg Intelligence senior analyst Mandeep Singh. You know, it's interesting when we talk about Intel here and the global competition. I was talking to an investor based in the U.S. the other day about whether they would invest in the Intel story should they see these other turnaround plans. And they drew very specifically the competition with TSMC. U.S.-based investor still doesn't believe that the U.S. story can catch up fast enough. What do you think?
Yeah, I think right now, with 3 years of Pat Gelsinger trying to turn this company around, clearly, you know, it's hard to conceive Intel as a whole really recovering from, you know, the missteps they had. But the timing of, you know, the Qualcomm news and the Apollo investment does suggest that valuation has gotten to a point where a lot of the bad news is in the stock. And when you look at the Intel, you know, some of the parts valuation, the PC business is where they still have a dominant 70 to 75% share. The server business is where they're losing share, and foundry business is clearly where all the problems are. So from that perspective, it does make sense, you know, that there is a floor to how low the valuation can get, and that's why you're seeing these news, you know, in the last 7 days.
Does it matter if they have a dominant share in the PC business? Is that like having a dominant share in the printing press business? I mean, are we still going to continue to buy and use those things?
Actually, when you think about AI wave, you know, and how transformational it's going to be, right now all the focus is on data centers and, you know, just new types of chips in data centers. At some point, this is going to trickle down to smartphones. It's going to trickle down to PCs, and there will be a big refresh cycle. I know you've been, you know, hearing a lot of people calling that out.
Dell.
But look, I mean, how else are you going to use AI? if it's not on your phone or your PC, it's hard to imagine, it being that big as what people make it out to be. And that's where I think right now you're going through that inventory correction in the PC market. And it's hard to imagine that, you will not see a rebound in PCs, even though the market is saturated, but there will be a big refresh cycle in PCs, and you can't just move away from Intel when it comes to PCs.
Well, I feel like you identified an existential question there, and that's how are we going to use AI? I'm not going to ask you exactly that, but I want to talk about all the different companies sniffing around Intel right now. That's really the theme of the day, of the week, is that everyone wants a piece of Intel. How badly does Intel need an investor like Apollo or a deal with Qualcomm, for example, when you think about all of the massive capex that they have planned to basically catch up here?
Yeah, I mean, look, when you have a negative $20 billion free cash flow, there's a lot of pressure. And that's what Intel is going through, is you can't just keep investing capex when, you are losing $20 billion a year, and it's reflected in their stock price. And as I said, when it comes to Qualcomm, there is a strategic alignment. Qualcomm really wants to double down on the PC side. They're big in smartphones, so Intel gives them that. On the foundry side, everyone wants to make chips here. Clearly, Intel hasn't caught up to TSMC on the process node side, but that's where you want to keep investing. And I think it's hard to do that under one umbrella. That's where splitting the company makes more sense.
We also want to get your thoughts here, not on Intel, but on Palantir, also moving this morning on the idea here that perhaps valuation has caught up to it. Of course, it has been rising, especially on the S&P index inclusion. You have written about this, but at the end of the day, you have also written that the institutional shareholder interest may not be enough to support this valuation. What does it need?
Look, when a stock is trading at, 35, 40 times forward sales, again, we've seen this cycle before. In 2021, the SaaS names were trading like that. And Intel, in the case of Palantir, it's been deemed an AI winner. That's what is reflected in the case of Palantir. And, at the end of the day, they have 500, 600 customers. This is a very concentrated company. Half of the company is government customers. They've done well on the commercial side. But it's not a business where you are going to see, rapid 30, 35% growth in perpetuity. And that's where, it's hard to make a case that, they will continue to grow at the pace that they have. But, time will tell if they can execute on this valuation. The pressure is more tied to the valuation than anything else.
Did you see the video of Alex Karp running in the woods with the poles talking about the index inclusion?
Look, it's a big catalyst, in terms of drawing interest. Palantir is a company that has a lot of retail interest, so it's definitely played out well. The problem or the challenge is in meeting expectations, because when you're trading at 40 times sales, the estimates and the expectations go higher.
And Alex Karp could be also personally a problem, right? When you say, did you see the video of Alex Karp? I'm like, oh no, what did he say this time?
No, just on the index inclusion.
Okay.
He was in the woods. Comments are turned off on YouTube, but you can view it there. Anyway, Mandeep, great to see you, of course. That, of course, is Bloomberg Intelligence senior analyst Mandeep Singh. Meanwhile, you take a look at futures right now. Of course, we are minutes away from the opening bell. You can see the S&P 500 currently up about 0.2 pre-market. The NASDAQ 100 not too far away. The small caps are your winners right now. The Russell 2000 fighting back, currently up about 0.5%. Meanwhile, let's take a look under the hood and look at some of the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
One stock helping the S&P 500 and NASDAQ futures, Katie, is Tesla. Shares are up about 1.8%. This as we have Barclays coming out saying that they think that third quarter deliveries will be a little bit better than what the street is estimating. On the other hand, General Motors is down. This as Bernstein has cut shares to a market perform. Lots of headwinds there, according to this firm, and including continued inventory pressures, a delayed EV ramp, and then international pressures as well. Turning to a big winner, one that's probably a little bit less known, but Biohaven, these shares are up 14%. The study has achieved a study for the firm has achieved a primary endpoint against progressive brain disorder. Now, there is a 12% bearish short interest there, so I suspect a lot of this is a short squeeze against a binary outcome day and test. And then finally, if we take a look at the shares of Ulta, they are down 1.3%. TD Cowen has cut shares to a hold from a buy. They say that rising competition is an issue, plus there's a lack of execution, and valuation is full. Sonali.
Thank you, Abigail. Now, coming up, the German government does not want a UniCredit Commerzbank merger, but the Italian bank just upped its stake. That's in high interest next. This is Bloomberg.
Now to high interest to look at what's making headlines around the world. Latest Israeli strikes on Hezbollah in southern Lebanon killed at least 100 people and injured 400 others. That's according to local authorities. Hostilities between the two sides have been escalating since pager and walkie-talkie explosions in Lebanon last week. U.S. Defense Secretary Lloyd Austin spoke to his Israeli counterpart and urged a diplomatic solution. UniCredit CEO Andrea Orcel is set to more than double the bank's stake in Commerzbank. It's the latest dramatic development on the ongoing takeover attempt. The move could escalate tensions with the German government, which has indicated that it opposes a deal. And a massive strike is threatening major East and Gulf Coast ports in the U.S. Around 45,000 dock workers are looking to walk off the job on October 1st. Talks have been at a stalemate since June. Industry officials believe a strike is inevitable. Ocean carriers and port operators have started sending out customer advisories. Sonali?
We're going to get back now to the markets with Envestnet Co-Chief Investment Officer Dana Daria. And, you know, we are standing here on a day. Futures are higher. We're coming off of another week of gains for the S&P 500. A little bit of exuberance seeping in after that mega cut by the Federal Reserve. And more people now baking in the chances for another 50 basis point rate cut. Is there a continued bull case for this market, Dana?
Yeah, I think bull case has to be base case at the moment because, you know, certainly the 50 basis point cut was on the upper side, surprised a lot of us, I would say, who were hedging bets a little and thinking that they'd start with 25. But, you know, we've heard Kashkari obviously talking about this, and, you know, their understanding, I think, is notwithstanding what they're saying, is that you know, the comments they made is that they might have been a little bit behind, right? That if they knew what they know now, they probably would have cut in July. So, you know, I think they're playing a little bit of catch up. They do expect another 50 by the end of the year. The market seems pretty settled on that, which is kind of nice, right? Because clarity can help with market volatility. And I think the bull case is certainly, you know, the base case, but I do expect a lot of volatility throughout the course of the rest of this year.
The bull case is the base case. Let's get a little bit more specific, though, Dana, when it comes to the actual sectors and industries you're looking at, because you have a lot of people pointing to the playbook of you buy defensives after the Fed cuts rates. You go to healthcare, you go to utilities, you go to staples. But then you have the likes of Mike Wilson from Morgan Stanley saying that actually it's time to take profits on your defensives. Where do you fall?
So it certainly depends on why you think this Fed is cutting rates, right? If you think recession, and I think everybody's kind of switched from an inflationary concern to a recessionary concern, as is done, right? As one does so fast, which of course, you know, but if you're worried about recession, you are moving into defensives. And, you know, the reason that the Fed is often cutting rates, especially because the Fed lags, is that they are concerned about recession. And so this leads to kind of traditional advice that says, hey, look, get to defensives. We're getting into a softer period, and the Fed is reacting to that and cutting rates. But if you believe that the economy is actually fairly strong still, that we have a ways to go before softness is really going to seep in, then you would push to areas that did very well last week, like small caps.
Does it still make sense to buy? I get, you know, that the Fed is not cutting into a recession, it's cutting into growth right now and already loose financial conditions. But does it still make sense to buy utilities or big dividend payers as rates come down?
Yeah, I mean, I think there's the case for that for sure. And when you think of dividend payers too, you end up with oftentimes lower price stocks. And I am a proponent to, you know, kind of because, you know, you have a big slug of these big Mag 7 growth stocks. You have a big slug that's invested in the AI theme, whether you picked it out or not, right? If you're invested in this market, you're there. So I think buying dividend payers and leaning a little bit toward, you know, a different play is not a bad idea because it hedges your bets and diversifies a bit.
Let's talk more about the small caps for a minute here, because that has been a fickle trade. We have seen bits and starts here of fits and starts rather, of investors getting into small caps and then deciding, well, wait a minute, these are still highly levered and maybe 50 basis points is not enough to get us to a place where we're comfortable with them. How far lower do rates really need to go before that leverage stops mattering?
We have a considerable amount of rate cuts in front of us. So I think small caps have a tailwind in that respect, right? 50 basis points end of this year, probably 100 next year, another 50 year after that. So what the market is pricing in now is pretty good for small caps. I think the issue with small caps is, the quality concerns, right? They are more highly levered. They are more dependent on interest rate conditions because they're more dependent on capital markets in general. And what we're seeing recently with small caps as well is that it's below average in terms of profitability. So the names in the index on an average basis are not as profitable, right? And so, that raises concerns. And one way you can deal with that, of course, is you can have a quality filter on your small caps. Another way, frankly, to deal with it is just to make sure you're holding a very broad-based, diversified small cap index or solution or even active management strategy, because you don't really know which small caps are going to benefit. And historically, when small caps benefit a portfolio, it's oftentimes because some names get bigger, right? And picking those out ahead of time is more difficult. So I think in the small cap space, you want to go well diversified or quality.
All right, it's a great point, of course. If you just blanket buy the Russell 2000, you're going to pick up a lot of junk along the way. Dana, always great to speak with you. Our thanks to Envestnet Co-Chief Investment Officer Dana Dioria. Now coming up, Boeing ousts the head of a troubled space unit after billions of dollars in losses. That's in our Social Climber segment up next. This is Bloomberg. All right, it's time now for Social Climbers, the company's making waves this morning. And first up, General Motors announcing it will temporarily lay off 2/3 of the workers at its Fairfax assembly plant in Kansas as it prepares the facility to begin production of the next Chevrolet Bolt model, which, of course, the automaker will roll out a new generation of next year. Next up, Boeing is ousting the head of its troubled defense and space unit in the first major shakeup by Kelly Ortberg since he took over as CEO last month. Remember, the space business has suffered billions of dollars in setbacks, notably NASA's recent decision to send Boeing's Starliner capsule home without the astronauts it launched into space in June. Meanwhile, I take a quick check on futures. Of course, we are minutes away from the opening bell. Green on this screen. We'll see if it holds. This is Bloomberg.
Moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We have markets heading higher, even though the S&P was already closing at over 5,700 on Friday. You've got gains on S&P futures, NASDAQ futures, and Russell futures. A lot of Fed speak out today with speakers sort of sticking to the median of the dot plot, saying we could have another 50 basis points of rate cuts so far or in the rest of this year. Here you see the New York Stock Exchange. Wow. That's the Argentinian leader there ringing the bell at the New York Stock Exchange. Down on the NASDAQ marketplace, building the futures summit, taking the spotlight. In terms of what's going on with the major indexes as they start to get settled in, let's get over to Katie Greifeld and see where they're moving. Katie?
All right, 23 seconds into this Monday trading session. You can see, as Matt said, we do have green on the screen. Of course, the S&P 500 currently up about 0.2%. Big tech and then the small caps also rallying as well. We're coming off 2 straight weeks of gains. We are just a whisker away from those all-time highs. We'll see if we get one today. But let's take a look at the individual stock level because we have to talk about Intel climbing after sources say that Apollo has offered to make an investment upward of $5 billion in the troubled chip maker. Of course, we got that Qualcomm news last week as well, late last week, looking at a friendly takeover here. So a lot of people lining up around Intel. Shares currently up about 2.5%, Sonali.
Elsewhere in technology, Katie, we're also keeping an eye on Palantir and Dell as they enter the S&P 500. Of course, remember, there was a big run-up heading up to this moment, but Palantir was just downgraded by Raymond James due to its high valuation. You do have Palantir shares down almost 0.5% in the market open, and Dell down about 0.3%.
All right, let's round out this conversation now with Bloomberg's Jess Menton joining us on set to my left. And we were just talking about the playbook for rate cuts in the stock market with Dana Dioria. And the reason I brought that up was because you had a great piece on the terminal with some of our Bloomberg News colleagues about basically there's no playbook here, that this time maybe it's different.
So everybody wants to harken back to prior cycles. And we did the same thing once the Federal Reserve began their hiking cycle just a few years ago, and especially when there was the bear market in 2022. So when I've been speaking with my sources, it was sort of this conundrum of what do you do? Because normally in past playbooks, it was usually utilities tended to do the best, those bond proxy-like sectors, as well as healthcare and other corners like that. And the worst were technology if you look 6 months after the cutting cycle began. But you already have sectors like utilities. I mean, that's the second best performing sector in the S&P 500 this year behind technology, but that's also an AI play. So that sector's up over 25%. So then what do you do? So you have people like Savita Subramanian over at Bank of America. She's making a call for more value, large cap type stocks, and then also large cap over small caps, even though small traditionally outperforms
This is what I was looking for.
Right.
I mean, I read your story with interest, and okay, if it's not the defensive play, utilities obviously still do well because it's like the fact that they're cutting into growth rather than cutting into a recession, that's the difference, not the fact that they're cutting. So utilities, big dividend payers are still going to be winners, but I was reading through the story like, who should I buy? Walter Todd is saying buy financials, right? David Lefkowitz is saying he likes financials too, but also cyclicals. And then, as you mentioned, you know, big value is favored by Savita Subramanian as well.
And then also industrial type companies because those are closely tied to the economy. And then discretionary.
Cyclicals, right?
Exactly. So
Yeah.
you can also have that broaden out to cyclicals too, which Savita Subramanian was talking about as well when you look at that. But then also everyone wants to talk about how strong the economy still is. If you look at the Atlanta Fed GDP Now model, obviously the current quarter around 3%, but also it's very rare to see the Fed cutting when you also have corporate earnings expanding. So 8 of the last 9 cycles, usually corporate earnings for the S&P 500 were decelerating. You're seeing that earnings growth continue to grow, not just for this year. I mean, we don't have that many months left, only one more quarter after this. But the next few years, you're still seeing that S&P 500 earnings growth continuing.
18% next year.
Yes, exactly. Bank of America made that call.
Expected, yeah, but I mean, still, that's a huge number.
Plenty of people telling us to worry about that 18%.
But if they miss it,
though.
if it's 14%, is that still not incredible?
Well, does it
Double-digit
justify
growth.
these valuations?
Right.
Let's go away from the indices for a second and talk a little bit more about single name stocks as well, because what's interesting is you are seeing analysts really catch on to single names and sectors that people worry about.
And one of those names is Keurig Dr. Pepper. And I bring it up because it's a consumer packaged good company. This is a company also when it comes to even just the industry as well. Tom Barkin, who's obviously at the Richmond Fed, he was talking about this earlier this year when they were debating on when they were going to cut rates. But this is a key metric when you're thinking about the guidance when it comes to inflation, but then also what this tells you too as far as the volume growth coming out of COVID. So the reason here is you're seeing a little bit of a boost here, up about 0.5% for this stock this morning, coming a little bit off of the highs, but Citi actually upgraded the stock. And also they were talking about specifically more of the coffee volumes as well as beverage. And that's something Jen Bartashis over at Bloomberg Intelligence has talked a lot about because people want to know when they're going to the grocery store, when do you get more of those deals like buy one, get one half off, things like that. And so she was pointing out we would expect to hear more companies in the second half of the year in the consumer packaged goods space say that. And we've already seen that most recently in those earnings reports. So that's important when you do have more conviction on a company like this.
If you have to go back to work 5 days a week, I guess you need more coffee too.
I don't drink coffee. You know?
That's
Really?
someone who
Tea.
sits
I
in
drink
that-
a lot of
you
tea,
drink a
like
lot
10
of tea
cups.
as well, too, though.
obscene amounts of tea.
But do you drink Dr. Pepper? Because that's been the real story for them. The
I will
kids
say,
love Dr.
so
Pepper.
first off, no, because I don't want to get diabetes.
Right.
But if
They
I
have
were
diet.
going to drink a super sugary sparkling beverage, it would be Dr. Pepper. It is my favorite of all the soda pops
I feel
you
like
go.
that you could
Katie's more of
possibly
the
drink.
Starbucks, right? You're on the
love
Starbucks train.
Starbucks.
Yeah.
It's been a rough ride, but yeah.
You know what's, last week when you were out,
Yeah.
there was an amazing story. Microsoft is going to buy 2 decades worth of power from 3 Mile Island.
That is an amazing story.
Constellation Energy is going to run the plant. I mean, they run the plant.
Yeah.
And
Well-
did I hear that you got an interview with the CEO?
I am, and we have a beautiful promo that I'm going to do. But I do want to go back to that theme
Great
because it really
segue.
fits into what we were talking about, that utilities, okay, they're defensive categorically, but it just feels like we can't get away from that AI trade, that even the defensive names are connected to it.
And now nuclear energy is an AI trade.
Yeah, and so Constellation Energy, it's in the electric component when you are looking at the sub-industry groups in the utility sector. But actually, if you're looking at this, Morgan Stanley is actually more positive on this stock. And it has to do with what you were talking about just now, that deal with Microsoft. So if you're looking at this, and of course, this is the biggest U.S. operator of nuclear reactors here. So they raised their price target. And if you're looking at this as well, too, it's around $313. Previously, it was $233. So if you lose that implied move from where it closed on Friday, that would be actually another more than 20% gain from here for that particular stock. So that's the call that Morgan Stanley has for this. So something to keep an eye on, because we were just talking about the stellar gains that utilities have been on so far this year.
Yeah, that's been the dark horse there. Jess Menton, it is always a delight to see you. That, of course, is Bloomberg's equities reporter, Jess Menton. And as Matt said, I am talking to the CEO of Constellation Energy today. That's at 12:40, maybe 12:50 p.m. Eastern. We'll keep you updated on that. Don't go anywhere, though, because coming up, Americans, as we were just talking about, riding a caffeine high. Coffee consumption has been hitting 20-year records, and that has Citi bullish on Keurig Dr. Pepper. More in Top Calls next. This is Bloomberg. This is Bloomberg Open Interest. Let's take a check on the stock market right now. Not huge moves right now on the indexes, but this isn't a market that needs huge moves. Of course, we are so close to those all-time highs. The S&P 500 up maybe 0.2%. We'll see if that's in the offing. Meanwhile, you have small caps as your big winner on the day. The Russell 2000 currently up about 0.4%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Citi upgrading Keurig Dr. Pepper to a buy on better U.S. coffee volumes. The analyst says that the coffee business has been the main reason for the company's underperformance over the past 2 years, but says that it should now benefit from those easier comps. Next up, we have Raymond James downgrading Palantir, saying that it's no longer a buy. The analyst says that the stock's recent strong performance and its rich valuation leaves little room for error. You can see shares down marginally right now, of course, following a monster rally. And finally, we have Deutsche Bank upgrading BNY Mellon to a buy, citing stronger conviction following investor meetings with the company's CEO. The analysts over there see earnings growth in the double digits, Matt.
All right. I mean, just love to hear about European banks, especially German banks right now. That has nothing to do with it, but I wonder what Deutsche Bank is saying about Commerzbank. Let's get to the broader themes here. Stocks steady as investors await more Fed speak and PMI data due out here in just a few minutes. We did have PMI data out in Europe, and it was a disappointment with the composite falling to a contraction to a level below 50 for the first time since February. Here with more is Bloomberg macro strategist Cameron Kreis. And Cameron, we saw that lead to a bull steepening in German 2s, 10s, right? Is that the reason that we're seeing more of that here as well? Is that encouraging the U.S. Treasury market?
Well, we've kind of eased back a bit in Treasuries once New York came in. But listen, it just reinforces a broader trend of curve steepening, which, thus far has been primarily bull steepening. And that just really reflects the move across most major central banks towards cutting rates, which is a sort of a classic recipe for curve steepening.
Can I just jump in here and ask you is there a simple way to explain bull steepening versus bear steepening to those who aren't steeped in treasuries markets and why it matters, Cameron?
I see what you did there. So so obviously a curve steepening is when short-term interest rates go down relative to longer-term interest rates. Now, excuse me, a bull steepening comes in the context of the overall level of rates coming lower, and is typically what you associate with monetary easing. Short-term, as the Fed or other central banks cut interest rates, the policy rate is obviously a very, very short-term interest rate, and that has more of an impact, say, on the 2-year yield than the 10-year yield. A bear steepening comes when either the general level of interest rates is moving up, or more particularly the back end of the curve sees yields rising. And there, you more think of it in terms of an increased risk premium,
right,
either because of inflation or perhaps because of worries about government issuance and deficits, which is obviously still a fairly relevant topic in the U.S. in particular.
Right. Well, Matt is taking careful notes on those definitions, but what you really need to know is that the yield curve is steepening. I want to talk a little bit about the playbook here. When it comes to the bond market, we were talking about it for the stock market, what you do after this jumbo cut from the Fed. How does it play out in the bond market? Where are people placing their bets right now?
Well, I think for the most part in the steepener, because it's sort of it's almost like a heads I win, tails you lose. In the sense of, if you think sort of the two major themes in terms of monetary and fiscal policy, the Fed is just embarking on an easing cycle, and they have signaled through their forward guidance that it's going to be a fairly significant easing cycle. Now, whether the neutral interest rate is 2.5%, 2 3/4, 2 7/8, or 3%. The general consensus is it's a fair amount below the current level. So that would imply a fairly reasonable scope for easing, which would be supportive of sort of the bull steepener. And at the same time, the deficit is still a mess. It doesn't look like it's going to get any better, kind of no matter who gets in, at least in the near term. There's an argument to be made that after 2025, it could improve if the Trump tax cuts are not renewed, which will essentially raise personal tax rates and therefore increase revenues. But while the deficit remains so high, particularly relative to the level of economic growth, that continues to put pressure on the Treasury to issue more debt, and that remains sort of the back of mind as well. So if the economy starts picking up,
to that end, also, because we had been talking about it and you are actually seeing a little bit of movement in the bond market on top of these PMIs, you're actually seeing the U.S. global September manufacturing PMIs hit a 15-month low. You are seeing a little bit of a spike higher in the 2-year right now. You're seeing it coming in lower than expected. So what does that mean to you for the U.S., Reed?
Well, I don't think the manufacturing PMI is particularly important, given how small the small component of the economy manufacturing is. The composite PMI, which also includes the service sector, actually rose, or not rose, it came in very slightly higher than expected and broadly unchanged relative to it's very slightly below the prior reading. So I think that is more relevant and would be more of an explanatory variable as to why short-term yields are popping a little bit on the back of it, sort of not as bad as perhaps feared. And I think it's also important to remember that in the modern era, say going back to the start of the 1990s, the Fed has never started easing with financial conditions this easy. If you look at, say, the Goldman Sachs U.S. Financial Conditions Index. And that kind of raises the question of actually, are they going to have to go as far as they think they're going? Because financial conditions are pretty easy already. And if they're going to put more stimulus into the economy or remove restriction, I guess is the more apt way to characterize it, with conditions this easy, is that actually going to generate more growth and potentially more inflation than anyone is looking for at the moment?
Cameron, we have to leave it there. We thank you so much for all of your analysis. Of course, that is Cameron Price, who is all over the macro world here at Bloomberg News.
Macro man.
Macro man. Yeah, don't miss his column either. Coming up, we're going to dig into Apollo's growing interest in Intel as the chip maker struggles to capitalize on the AI movement. That's next in our Wall Street beat. And also, Japan's prime minister is participating in a panel discussion here at Bloomberg. He is speaking with top executives from firms including BlackRock, KKR, and State Street Global Advisors, all of which have huge interest in the country, of course. You can watch this live event on your terminal at Live Go. This is Bloomberg.
France called TKO. It's a listed company. They're very, very strong in that space, and they're now very deep partners with us. So they bring a skill set into Japan that is maybe not as strongly represented yet. And for them, the benefit is they have have an immediate access to Japan into every single channel through a domestic company. So I think that that's something that I've really felt has been extremely beneficial.
Welcome back to Bloomberg Open Interest. Let's take a check on stocks right now. About 21 minutes into the U.S. day, you can see that the S&P 500 building on that momentum that we saw the past 2 weeks, currently up about 0.2%. The NASDAQ 100 a little bit higher, up 0.3%. Meanwhile, the Russell 2000, that had been your early leader, now slipping back a little bit, but still up about 0.2% on the small cap index, Sonali.
And it's time now for the Wall Street Beat. We've been talking about the multi-billion-dollar investment that Apollo Global Management might put into Intel, according to Bloomberg sources. Remember, back in June, Apollo's co-president Scott Kleinman spoke to Bloomberg's Danny Berger, anticipating more deals that they have done, like the one they've done with Intel. Take a listen.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
We're going to discuss Apollo's thinking here with Bloomberg's Liana Baker, who broke the story with her team over the weekend, leads the U.S. deals team here. And if you think about Apollo's existing relationship with Intel, with the chip industry, why is this such an interesting development in the deal talks for what could otherwise be an acquisition from another company for Intel, which is now worth more than $95 billion? Does Apollo's interests complicate any potential takeover talks?
We're trying to figure that all out to see if this Apollo offer is an alternative to Qualcomm, or, could it also invest in Intel and then later Qualcomm buys Intel? We don't have those details right now, but we do know that Intel's board has to consider everything. They've said they're open to everything. So Apollo coming in with sort of a creative solution is one thing they could look at. Apollo, as you mentioned, is already tied up with Intel in their Irish plant. They've already put in billions. So they definitely are, want to see Intel succeed here and not, fall by the wayside. A Qualcomm takeover of Intel is something we're still looking at, but that is a deal that could take a long time. We're hearing that an Apollo investment would be something that could be much faster and, bring that capital that Intel might need.
I sense government involvement lately with Intel announcements. I don't know if that's just my sort of deep state paranoia or if they really are sort of helping them to get Pentagon contracts, helping them to work with Amazon, helping them to get an Apollo investment. Do you hear any of that?
Story.
Do you hear any of that?
So with the U.S. CHIPS Act and Intel expected to receive billions, I wouldn't be surprised if something like that was going on. Right now, we don't have the reporting to say, the U.S. government is behind any of this. But certainly a merger with Qualcomm would be something that the U.S. government would have to put their stamp of approval on to have sort of a U.S. solution. Without the government and antitrust and DOJ and everyone on board, this would be really a tricky deal to happen. So they definitely are monitoring this closely, but we can't say if they're,
Well, focusing
pulling it all off.
on the Intel part of this, of course, Intel and Apollo, they already have a relationship. You think about what happened in June when we had Intel agreeing to sell a stake in that joint venture that controls a plant in Ireland to Apollo. And Apollo also has experience in the chip making space when you think about relationships that they have with Western Digital as well.
We've reported on the Western Digital investment. They put in, some $900 million. This would be a lot bigger. That deal was last year. Western Digital is a lot smaller than Intel. They didn't have an existing relationship with Western Digital when they did that. So this is kind of the next step. You also should know that Intel has a relationship with Brookfield. Before Apollo came on the scene, Brookfield was a partner in a plant in Ohio. So that's another name that we're kind of looking at. So far, we don't have the reporting to say Brookfield is there, but Intel's clearly open to talking to these alternative asset managers.
If Apollo and Brookfield have these existing relationships, could you look at a scenario here where you have a club deal, where you have many investors come in? Is that kind of the place we are now, where most of Wall Street is tied up in this story?
That would be a fantastic club deal if all the private equity firms could combine to take Intel private. I'm not aware of something like that happening, but I think
up
definitely
the valuation now, at least. They don't need to even take it private.
I think some of these partnerships with private equity could come at the right time for Intel, which, you showed in the video. You said Scott Kleinman said there's insatiable need for capital. Intel kind of has that right now, actually. So it's a good time for these alternative asset managers to come in and help.
Leanna, great having you on the program. Thanks so much for joining us. It's a fascinating story. I'm sure we'll talk a lot more with you about it in the days and weeks ahead. Bloomberg's Leanna Baker there. Let's get to the trading diary, what you need to be watching. We'll get plenty of Fed speak through the week, including Austin Goolsbee and Neil Kashkari today. Tomorrow, we get consumer confidence data to keep an eye on, followed closely by U.S. jobless claims, durable goods, and revised GDP on Thursday. And then Fed Chair Jerome Powell gives us pre-recorded remarks to the 10th annual U.S. Treasury Market Conference. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, markets are waiting for signs of what's next from the Fed after last week's big cut. We're going to get a slew of Fed speak this week and economic data all week long.
6 weeks and counting. The battle between Harris and Trump over the economy is set to intensify, with the rivals planning dueling events this week.
And a transformative shift is underway at one of the world's largest jewelry brands. The CEO of Pandora joins us in studio for today's C-Suite conversation. Before we get there, let's take a check on these markets right now. We do have a rally underway, but boy, is it small. You take a look at the S&P 500, currently up about 0.1%. The NASDAQ 100, your big tech index, up about 0.2%. Of course, we've seen really big gains over the past 2 weeks. Now the question is, what's next? We, of course, have the Fed out of the way, earnings out of the way. We'll see. Meanwhile, the bond market pretty quiet, yields up about 4 to 5 basis points. Meanwhile, we shift our focus over to politics because the latest New York Times and Siena College polls show that Donald Trump is gaining strength in the Sun Belt. Trump increasing his lead in Georgia and Arizona as his lead shrinks in North Carolina. All indications pointing to one of the tightest presidential elections in history. Joining us with more is David Gura, host of Bloomberg's Big Take podcast. And David, so the polls, we talk about the polls, but I feel like after each we need to say within the margin of error. This is still tight.
Yes, and that's true of all three of the ones that we got. So the NBC News one, CBS Ipsos, and then this one from the New York Times and Siena College. And that's perhaps the most interesting because it gives us new insight into these three swing states, Georgia, North Carolina, and Arizona. And so we know Joe Biden won Arizona in the last election. Kamala Harris is counting on it for her pathway to get to the 270 electoral votes that she needs. This shows her behind, but yes, within the margin of error. And I think what's interesting, if you look at the NBC News poll in particular, she is seen by voters as a change candidate. And there's something so astonishing about that the vice president to the incumbent president is seen as more of a change, more different than Donald Trump would be. But she's certainly trying to capitalize on that and trying to focus on the economy in specific going forward.
Have you seen WSL Elec Map go?
I'm sure he has.
We have the most amazing dashboard. I mean, WSL space election, but WSL space Elec Map will give you sort of a map of the U.S. and show you the spread. Here it is. Check that out. I mean, the power of the Bloomberg terminal is insane for this election.
Are they paying you?
Well,
indeed they are.
But yeah.
What are the chances of Harris taking? Look at North Carolina. It's not deep red or blue. Look at Georgia. You know, look at Arizona. I mean, these really are up in the air.
Each of them critical. I'm from North Carolina and know the political terrain there pretty well, and there's been a lot of talk for many cycles about the purpling of that state. So Barack Obama won it, Donald Trump won it twice. It is now beset by this scandal involving the lieutenant governor who is running for governor, Mark Robinson. That is a real gift to Democrats here. And so over the weekend, we saw Donald Trump going ahead with his trip to North Carolina, gave a rally in Wilmington. Did not
with Mark Robinson?
No.
Did they
not
embrace?
Bring up or mention Mark Robinson, who did a quick meet and greet at a race car track elsewhere in the state. He does have 2 speeches scheduled today, but this is causing a huge headache for them. And I talked about the pathway to getting those electoral college numbers. North Carolina is critical, as is Georgia, as is Arizona.
Well, how much do the next couple of days matter? We know that the economy is a battleground as well for a lot of these states as well as the country. And this week, we are expected to hear new plans, presumably from both candidates. How will that start to change the playing field?
So again, looking at these polls, the issue that voters care about is the economy. They complain about inflation, complain about prices. And so Kamala Harris was in New York over the weekend. She did a big high-dollar fundraiser, and she promised that we'll have a speech this week in which we'll get more meat on the bones, more details on her economic policy. You look at former President Trump's travel schedule this week. He's going to Georgia, Michigan, J.D. Vance making similar trips. they are doubling down on this focus of taxes, the economy, inflation, immigration as well. So we'll see if they stick to that, but they clearly recognize the fact that in these polls, that's the issue that's percolating up.
All right, David, great to have you on the program. Love listening to your podcast as always. David Gura is the host of the Big Take podcast. Thanks for joining us. You can follow the latest on the election. We have these WSL, these worksheet sample libraries that I love, but the sort of broader view by typing ELEC GO on your Bloomberg terminal. Let's take a look now at how markets are positioning ahead of the election so far. Joining us to talk about that is David Rosenberg. He's the president of Rosenberg Research. And David, what do you think, if anything, these markets can tell us about the outcome in November?
Well, I think that the bond market may be starting to give you a bit of a signal with the fact that, we had that jumbo rate cut out of the Fed, and the 10-year Treasury note yield is up at least 10 basis points from that meeting. And that's pretty unusual. You would have thought that fixed income would have rallied, but it's sold off. And of course, as you just said, looks like both Trump and especially Harris are going to unveil even more economic agenda. And the economic agenda is basically there to buy votes, and buy votes through giving more candy to the citizenry out there. So I think that the bond market in particular might start doing some math as to what are the fiscal deficit implications of layering on all the stimulus, and then at the same time, for all the banter about trying to sustain the downward trend in inflation, how does fiscal stimulus on the part of both candidates, play into that and possibly complicate, the Fed's move to continue to cut interest rates?
Well, we know that Americans, they vote with their wallets. They vote on the economy increasingly. So let's talk about the economy. Let's talk about the labor market, because we got some Fed speak already this morning, hearing from Kashkari saying that he backs another half point of Fed cuts this year, basically saying that the balance of risks has shifted away from inflation and more towards the labor market. We also heard from Raphael Bostic saying that that large cut that we saw last week, it should support the labor market from here. So clearly, of course, you have Fed members concerned about weakening here, concerned about the labor market. How are you viewing the balance of risks, David?
Well, I would fully concur that the labor market has emerged as a more principal risk than inflation. I'll say, inflation is never really dead, but it certainly is dormant, and all the leading indicators are pointing south. As far as the job market's concerned, a lot of the macro bulls out there only focus on one thing, and it's initial jobless claims remaining so low. And there's no doubt that layoffs and firings are still at very low levels. But I think what's caught the Fed's eye is the true leading indicator in the labor market, which is the hiring rate. And hirings they've been like a hot knife through butter. The hiring rate is starting to decline significantly, to the point where if things start to turn worse for the economy, all of a sudden, you're going to start to see negative readings on non-farm payrolls. That hasn't happened yet, obviously, because the firing rate's been so low. Companies are still hoarding labor. But the hiring rate, I think, is what's really caught the Fed's eye, and it's declining precipitously over the course of the past 6 to 12 months.
David, I want to get your view here on how choppy the off-ramp is here when we think about the Fed cycle, their ability to cut rates, but then realize also that there's a lag between when they cut rates and it impacts the real economy. With that in mind, how choppy could the next year get when it comes to employment, when it comes to growth?
Well, you mentioned quite accurately what's going to be influencing the economy for at least the next 6 months, maybe even 12 months, is the lagged impact of all the damage the Fed has done when it was busy fighting inflation. So everybody's all excited that the Fed has now started to cut interest rates, but that might only start to really influence the economy in a positive way in 2026. And 2025 will be the year where we continue to see the lags from the Volcker-like rate hikes percolating through the economy. The best example is that, the Fed under Bernanke and Greenspan, they raised rates almost the same as they did this cycle under Powell. And then all of a sudden they go on pause in the summer of 2006. We go in 2007, nothing seems to be breaking apart. We have the soft landing narrative that went all the way into 2008. But remember that the Fed thought it was moving preemptively. I mean, the Fed first started cutting interest rates in summer and fall of 2007. I mean, that was well before Bear Stearns, well before Lehman. And everybody thought, well, they're cutting rates in the summer, fall of 07, and we're going to breathe a big sigh of relief in 08. Remember, in 08, right up until Lehman collapsed, soft landing was everywhere, like we're hearing right now. But you see, what happened in 08 was we were still feeding off the lags of everything the Fed had done in 06, in 05, 06. And the lagged impact took over in a whole bunch of different ways. The economy and the markets into 2008, nobody saw that happening. The Fed cuts interest rates, they radically embark on quantitative easing, and then we got a recovery, really starting later in 2009, 2010. And that's how the cycle moves. Interest rates are a leading indicator, but they do operate with long lags. And this lag this time around was super long because of all the fiscal stimulus that got in the way. But that's in the rearview mirror right now. So I think that the lags work in both directions. And I think that, people are going to say the Fed's not behind the curve. The yield curve's been telling us that the Fed's been behind the economic curve for a long period of time. It's not evident in the coincident economic data that everybody's paying attention to, but the leading indicators are certainly pointing to a very rough year for the economy
but
in
David,
2025.
I got to wonder, if you see hiring headed down right now, right, at a time when the U.S. is finally, clamping down on border crossings, on immigration, doesn't the labor market start to tighten up at a time when the Fed is cutting rates? Isn't there a chance that inflation could come roaring back, especially if we get President Trump in the White House and he starts to put on tariffs, starts to export, immigrants, workers, and continues to cut taxes?
Well, fair enough. Look, we heard a lot of this when Trump got elected the first time in 2016. Tariffs, of course, this time his plan is, tariffs on steroids. But the part about immigrant labor, you're 100% right that he built that wall around immigration in his first 4 years. And we finished off that cycle with the unemployment rate before COVID, getting to roughly 3.5%. And there was no big wage spiral, and there was no big inflation spiral. And it just goes to show it's not saying that immigration isn't important when you're modeling out the impact on wages and inflation. But there's so many other things that go into any econometric model trying to predict these things. The point here is that you're 100% right. Ipso facto, we create tighter curbs on immigration. It is going to constrict labor supply. That's a no-brainer. But what's happening right now that is going to provide a more overwhelming impact on the labor market is that businesses in America are cutting their hiring rates dramatically. The hiring rate right now is 3.5%. It's actually lower, not just lower than it was pre-COVID. It's lower than it's been in the previous recessions going back the past 3 decades. Mm-hmm. So that has nothing to do with anything we're talking about. Yes, it will constrict the supply of labor, but what's going to happen that's going to be overwhelming to that supply constriction you're talking about is the demand for labor is going to be falling at a faster rate. And that's already starting to happen, which is why wage growth has started to subside.
David, we thank you so much. Our thank you to David Rosenberg of Rosenberg Research. Now, coming up, it's New York City Climate Week, and we're going to speak to the CEO of jewelry maker Pandora, who's reached a new milestone in this city. He joins us in studio, Alexander Lacik, the CEO of Pandora. This is Bloomberg.
Well, it's Climate Week here in New York City, and Pandora is setting a sparkling example. The world's largest jewelry brand announcing it will only use 100% recycled silver and gold for all of its products. The switch will avoid 58,000 tons of CO2 from entering the atmosphere each year. For more on this, I'm pleased to say we're joined now by Alexander Lacik. He is the CEO of Pandora. So let's talk a little bit more about this announcement. You stopped sourcing newly mined silver and gold in December 2023. Now all your products made from those recycled metals. I'll ask the simple question, since you make so much jewelry, how can you be sure that you're going to have enough?
Enough recycled silver.
Yeah, where are you sourcing that from?
So there is roughly 26,000 tons of silver produced every year, of which roughly 6,000 tons is recycled, and we buy roughly 340 tons, so 6-7% of the global. So there's enough to go around for a while.
Where are you buying it from, though?
This is from the main suppliers of this. This is the same people you would buy mined silver from. So that, you know, this is quite easy to get.
What's the
access to.
conversation look like with them? Because presumably they want to sell you the new silver and gold to keep their supply up in a significant way to boost that demand. Have they been receptive to moving to recycled, and has anyone else in your industry kind of followed you along the way?
I mean, recycled silver, as the same for gold, by the way, has been around for quite some time. So this is nothing new per se. The interesting fact is that silver is only, let's say, recycled roughly 20% of everything that's being used. So there's still a lot of silver that actually goes into landfills. So, you know, I think we, as the major player in the silver jewelry market, we're also trying to show the way that you can actually use recycled silver. It's the exact same material, so it doesn't age as such. And maybe by us showing the card, somehow we get more people to follow. If you imagine a world where all silver and gold jewelry would be made out of recycled material, we would save north of 50 million tons of CO2. And there's no reason why other jewelry companies couldn't do what we just announced.
And I mean, you take such a huge supply, 6-7% is big. We've seen prices skyrocket. Certainly gold is at an all-time high. Silver's still a long way off, but on its way up, right? What's demand look like to you, consumer demand, especially in the US right now?
So if you look at the silver market as such, the silver has moved. Pre-pandemic was roughly $16 per ounce. Today we're just clocking in north of 31. The amazing thing is during this period there's no increased demand for silver. So this is all politically driven. So uncertainty in the world, typically if you look historically, then people rush to gold. Gold then essentially has silver coming along with it. So I think just a few months ago was the first time where the silver and gold didn't necessarily move in lockstep. But in general, silver moves with the gold. So from a consumer demand standpoint, there is no increase in general.
But your pricing power remains strong?
As a jewelry brand, I mean, the way we go to market is by selling and offering a brand proposition, not a commodity. Yeah. Okay, so those are two very different aspects. If you look at historical traditional jewelers, was much more commoditized as a proposition. This is the last of the luxury segments that has such a still large proportion of unbranded players. Roughly 2/3 of all jewelry is still, let's say, unbranded. But the part that's growing is the branded side, which of course has a very different pricing approach.
Well, building on this conversation on pricing power, I'm curious how you're approaching discounting, for example, especially at this point in the year when we're starting to look towards the holidays. What is your strategy around discounting in the US, in the UK, given that you do have this global presence?
Yeah. So roughly 85% of all our products are sold at full price. Then you have roughly 15%, which is sold through what we call key consumption periods. So you have Mother's Day, Valentine's, and this period that we're entering. And there is a little bit of discounting going on, but this is not heavy discounting. It's not like 50% off or anything like this. It might be 10, 20% off on the select items. So we're trying to build the brand through kind of the innovation, the marketing, and not just by kind of dropping pricing. The pricing policy, sorry, just to finish off, the pricing policy across the globe is the same.
Is the marketing effect of going green helping reach new audiences as well, thinking about how much Gen Z in particular has been very focused on being greener?
Well, so what we are not doing so far is essentially broadcasting to our consumer base that we are in recycled silver or gold. So this is mainly for the employees, for the kind of stakeholders, the financial community at this stage of the game.
I do want to follow up on that point you made, though, that when it comes to the discounting strategy, that it's the same across the globe. That definitely caught my attention. Is that because that's just your policy, or is that because you think about the consumer across the globe, in the US, in the UK, is similar right now?
Well, I mean, I think this is a trading policy that we apply. If I had a kind of wish, let's say, I wouldn't do any discounting, to be honest. I would like people to come to the brand because they love what we have to offer. Now, the reality is when you're in a mass market like Pandora is, there is a little bit of discounting in certain periods of the year. So either you participate and you can take care, I mean, be part of that wallet that's open at that moment in time, or not. So that choice is kind of...
We're just trying to gauge the health of different consumer groups via your business. So...
And maybe we should ask about China. I mean, there's been a lot of fears about the Chinese consumer in particular. What are you seeing in that segment?
Well, China is a special case for Pandora. We have been posting double-digit growth for the last 5 quarters, in fact, except in China. We have a very difficult business in China. It's the one brand of all the brands I have in the world, or brand position, I should say, which we didn't do a good job when we launched way back when. Now, unfortunately, we have a very weak backdrop from a macro standpoint in China, on top of a weak brand, and there you go. It's not a nice story to write about. But that's 1.5% of my group revenue, so I can survive that.
Yeah.
But to answer your question, the consumer sentiment, I think, over the last 2 to 3 years has been kind of the same. It has not really changed much. We can see that after, in particular here in the US, when you had the helicopter money in 21, this market grew a lot, and then it's kind of been in a slight negative space. But the curve looked like this for 10 years, then it jumped like this, and my prediction was, well, it's just going to go straight back down again. It's actually stayed at a quite elevated level, but the market isn't growing here. It's kind of plus minus, let's say, a few points.
All right, fascinating stuff. Great to get your take. Alexander, thanks so much for joining us. Alexander Lacik of Pandora. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Take a look at markets right now. About an hour into the Monday trading session, you can see a rally building right now. The S&P 500 currently up about 0.3%. The Nasdaq 100 0.4%. We're very close to the intraday high. Haven't quite got there on an intraday basis, but of course, just splitting hairs here because we are very close to records right now, Matt. And you can see a lot of those gains coming from big tech right now.
All right, let's take a closer look at what's going on in the markets. For that, we're joined by Sonders, Charles Schwab, Chief Investment Strategist. Lizanne, great to have you on the program. You give us, I think, a great view from the vantage point of having so many trillions of dollars of investment under management. What do you make of the latest Fed cut, and what is to come is really the question being asked now. I've heard some, Michael Ferroli, for example, suggesting they could do another jumbo cut, another 50 basis points in November, but it seems to be the general consensus that we're just going to get 25 and 25 in the next couple meetings.
Well, we'll only know that when we have the data in hand. And even though I think the Fed announcement and in particular the press conference suggested there's a little bit more through the windshield analysis on the part of the Fed, looking at leading indicators like the hiring rate, keying more off the labor market than the inflation data, the latter of which is, of course, inherently lagging. But there's a lot of data between now and the November meeting, and I would anticipate that any significant shift in the labor market, particularly on the more weakening end of the spectrum, would elicit an increase in expectations around 50 basis points. I'm not sure that was the Fed's MO in launching with 50. I think they very purposely used that recalibration term, that sort of insurance cut. But I wouldn't bet that that is the path that they plan to take. I think the data is going to dictate that.
Well, Lizanne, what does significant mean in this context when it comes to the labor market? Because we heard from Kashkari, we heard from Bostic this morning, really driving home the importance of the job market at this point. What do you think would actually move the needle when it comes to these monthly reports?
Well, what we've seen so far is fairly tame initial unemployment claims. That's a leading indicator. We're not seeing a big increase in layoff announcements. I think there is still some credence to this labor market hoarding. You have seen hours worked cut. You're seeing a little bit less wage pressure. We've seen those downward revisions to payrolls. And then the aforementioned decrease in the hiring rate. So I think if it started to filter into those more traditional indicators, a lift in claims, a continued move up in the unemployment rate, not just downward revisions to payrolls, but weaker payroll prints in addition to those downward revisions, I think that would probably ramp up expectations that the Fed is going to have to stay on the more aggressive end of the spectrum. I don't think those are in the cards in the near term, but to your question of what would cause the Fed to feel compelled to sort of eye the elevator on the way down and not just the escalator on the way down, I think it would be those metrics within the labor market data.
The many metrics we're watching, another one is actually the housing market as well, Liz Ann. I know that you've been watching this very closely as well. It's, of course, a large part of a consumer's wallet. And as we watch interest rates start to decline and mortgage rates start to decline, you're still not seeing that movement yet in that housing market. Do you fear that the consumers really don't have that much dry powder to be spending on big ticket items like a new house at this point in time? What does that mean in terms of a roll forward of what else we could expect for consumers?
Yeah, so the decline in interest rates on the margin is a benefit to housing. But of course, since the Fed cut interest rates, you've actually seen the 10-year yield move up, and that's more of the proxy for mortgage rates. In addition, even though mortgage rates have come down, even at these lower levels, they're still well above the average effective mortgage rate. And you still have an affordability problem because although sales really compressed during the housing recession that we had in the aftermath of the early part of the pandemic, prices did not correct to the same degree. So again, on the margin, lower mortgage rates help, but it's probably not quite enough yet to free up that existing home market, which is really where the clench has been because so many people are holding a mortgage that's less than half the stated rate, or at least it was when the stated rate was at its high. So I think we probably need a bit more, but particularly on the long end, for us to see that existing home market free up a little bit more and maybe work its way into prices to the benefit of affordability.
And of course, we're going to be watching the housing market with bated breath. One of the most important and interesting markets to watch for the consumer. But as you say, we don't really know yet how it's going to turn out. In terms of the stock market, Liz Ann, we had seen a little bit of a rotation and certainly in earnings, right? The Mag 7 earnings growth has slowed down, and the S&P 493, as Gina Martin Adams refers to them, are starting to come out of the recession that they were in for the last 6 quarters. Does that continue? Do you think that has legs?
I think it does. You're looking at not a perfect convergence, but a convergence that's still ongoing from, to your point, Matt, the Magnificent Seven going from a year ago or so, 60% plus earnings growth. At the same time, you had virtually no earnings growth for the rest of the S&P 500. And you're in this process of convergence. It probably hits close to par as it relates to Mag 7 versus other 493 by maybe the end of this year into the beginning part of next year. Still a few percentage points higher growth from Magnificent 7, but given the valuation expansion, especially into the mid-July highs before that rotation kicked in, you still have that excess valuation. And quite frankly, I think one of the reasons why we saw a broadening out, it wasn't just some of the concerns about AI and the earnings trajectory, which we touched on, but the fact that at the all-time highs in mid-July before we had the corrective phase, in the case of the NASDAQ, you had more than 40% an average maximum drawdown at the average member level within the index. So the index had no more than still has had no more than a 13% drawdown, but now it's up to a 44% drawdown at the average member level. That represented carnage and turmoil under the surface, but also established an opportunity for money looking for opportunity for those more reasonable valuations because you saw so much more compression under the surface of these cap-weighted indexes.
Well, Liz Ann, what's interesting to me is that when you think about this broadening out, in some sectors, it still ties back to that AI story, which has been driving the Magnificent Seven. You think about utilities, for example, the great couple months that they've had, the great year, really, and a lot of that comes back to that AI demand for energy and data centers, et cetera. So, I mean, even when you think about the broad market, that broadening out, how much do you have to respect the AI story, both to the upside and when it disappoints as well?
I think AI is a portion of the utility story, but when you look at the other sectors that have done well, sectors that have more than 90% of their stocks trading above their 50-day moving averages, yes, utilities is one of them, but so's REIT, so's financial. So I think that there's an interest rate sensitivity story here in addition to that sort of peripheral AI story with regard to utilities. So I think the real story in this rotation has been away from the very expensive parts of the market, more cyclically exposed parts of the market, into that combination of interest rate sensitivity and a little bit of defensiveness.
The other thing here is, for all the concern about a sour September, that this could be a tough month, we're actually up on the month, and it hasn't been so bad. We've hit new records already. So if you think about the path forward and the expectations for earnings in the S&P 500 more broadly, do you think that they are justified? Do you think that there's still reason for worry outside of those big AI names?
I think we're probably okay for third quarter earnings. One of the things that we've seen in the almost to some degree the entire post-pandemic period is that analysts are sort of keeping their forward estimates a little closer to the vest. And it's in part by virtue of the fact that companies, given myriad uncertainties over the last 4 years or so, are not providing the same kind of precision around forward guidance. So what you tend to see happen is during reporting season, based on that reporting, based on the outlooks, they will adjust the next quarter. You saw that throughout second quarter earnings season, where you actually saw a haircut of about 50% to estimates for the third quarter. But as of now, you're looking at fourth quarter into the first half of next year, an immediate reacceleration back into double-digit territory. I'm not sure those are valid estimates. And I don't mean they're automatically way too high and have to come down. There's just not a lot of actual concrete guidance being provided. In addition, 2025's calendar year earnings, were they to come to fruition in that double-digit kind of teens area, requires profit margins to be pretty close to an all-time high. That's where I think the expectations bar for next year may have gotten set a little bit too high.
Quickly here, Lizanne, knowing what we know now about the trajectory of the Fed and the direction of the economy, do you have kind of a new playbook here? Are there trades that make more sense now to put on than they did a week ago?
Well, we continue to be more factor focused than sector focused. Sectors require sort of a monolithic view. Factors is investing based on characteristics. And even though you've seen some lower quality pops as we went into this sort of easing part of the cycle, we're saying you still want to stay up in quality. If you want to go down the cap spectrum to look for ideas, stay up in quality. Don't sacrifice profitability, return on equity, cash flow.
Lizanne, we thank you so very much for your time. That is Lizanne Sonders of Charles Schwab. Let's now get a look at some stocks moving this hour. Bring in Abigail Doolittle. Abby.
And first, Sonali, the S&P 500 itself is up ever so slightly, up about 0.2%. This after 2 up weeks in a row. So that followed the first week in September, which was down pretty strongly, the worst week since 2022. But right now, September not shaping up to be one of these terrible Septembers that it could be in the past. So again, a small move for stocks where we're seeing greater movement. The commodity complex, we have oil higher, although off of its highs. Natural gas sharply higher. This is some cool weather comes in. And then wheat, the grains higher as well. So commodities overall up 1%. In fact, oil not so long ago was at the bottom of a range, a year-long range, closer to $65 per barrel, back above 70. Let's put this into context to see if we can glean any details on what could be ahead for oil. So you can see over the last year, just this choppy range, not really making it all that far above 90 and not really making it below 70 with too much conviction. That said, there is a series of higher lows, or excuse me, lower highs here telling you that the buyers each time oil rebounds a little bit less excited. So it wouldn't be too surprising to see oil drop down toward the bottom of that range once again. And then finally, taking a look at some of the movers on the day, we have Tesla up 3.9%, a nice day, as we have Barclays saying that the company for their third quarter delivery is probably better than the estimate. Intel at this point up 2.4%. Lots of news on this company. This is really interesting. Apollo Global Management potentially have in fact offered to make an up to $5 billion investment in the company. This after last week we heard news of a friendly takeover possibility from Qualcomm. The investment from potential from Apollo suggests that some folks there really like the takeover plan in place. So investors like that possibility, given the fact that the stock on the year down more than 60%. Turning to movers that are to the downside today, GM down 2.8%, 2.7 to 2.8%. We do have Bernstein cutting shares to a hold, basically saying lots of headwinds out there for the company, including inventories. And then Trump Media and Technology Group down 6.7%, well below its March going public reverse merger price. And this, as there's just 2 days, today and tomorrow left, for insiders to file to sell shares. The stock under pressure ahead of that deadline, Katie.
Yeah, a lot of eyes, of course, on potential selling there. We'll keep an eye on all of that. Our thanks to Abigail Doolittle. Now coming up, the puzzle of economic mobility in the U.S. Aspen Institute's Dan Porterfield says that community colleges are an important part of the equation. This is Bloomberg. Well, it's time now for our daily Wall Street Week conversation. And the opportunity to move up economically starts well before students enter college, especially as more Americans lose confidence in the value of a college degree. Wall Street Week's David Weston asked Aspen Institute President and CEO Dan Porterfield whether there are other options.
Surprisingly to some, one thing that's working is community colleges are providing an even more powerful engine of access to the economic and social mainstream for immigrants and low-income people and first-generation college goers. The Aspen Institute runs a large project where we identify community colleges that want to work to increase upward mobility so that more of their students are able to graduate into family-sustaining jobs because of the curriculum and its tie to the local economy. And the Aspen Institute's program called College Excellence, led by Josh Weiner, has identified dozens of institutions that are really succeeding at propelling students into safe and secure, opportunity-rich jobs after graduating. That requires a number of steps, like A, tying the curriculum to the local economy intentionally by working with the companies. B, making sure that schools are expeditious in helping students graduate quickly. Third, developing programs with high schools so students can earn community college credit earlier. And fourth, working with colleges to make sure that community college credits earned are not then lost when they transfer to four-year colleges. You put all those steps together, and a number of institutions like Miami-Dade Community College are showing the way forward in that sector. I think another sector that's really working is the sector of, ironically, of highly selective schools that compete for students, where students compete intensively for access and admission. And those institutions have been, I would say, gradually but steadily increasing their access to low-income students. They haven't been as strong with middle-income students, and that's a problem, but they've been stronger than they had been in the past with first-gen college goers. This matters because the research of Raj Chetty with in Harvard has shown that the highly selective, high graduation rate, high financial aid institutions graduate and propel their students into upper income jobs, even if they come from low income backgrounds, with, at almost the same level they work with middle and upper income students. So expanding access to the top schools for low income students is a part of the equation, not the whole thing, but a part of it for increasing upward mobility in America.
You mentioned Raj Chetty, and just recently research has come out from Raj Chetty suggesting zip code by zip code, one of the biggest determinants, at least for non-Hispanic white males, is actually the level of employment in their neighborhood, not so much education. How does that fit with the education as a pathway forward?
Well, you're exactly right. There are a number of factors that contribute to economic mobility. And I think some of it is tax policy. Some of it's the ability of families to get investment in equity to buy homes. Some of it is the ability of small business people to get investment in growing their businesses and employing more people. Some of it is what other policies can we develop in America to make the entry-level job more of a springboard into economic security. That includes things like helping with portable benefits, helping families to save money, developing tax policies that incentivize parents to save money for education. And in all that, a big part of it is what's the ecosystem or the environment? Is it an opportunity environment that young people grow up in? And it's just a fact that when people see other people striving and succeeding, it shows them they can do it too. It creates a kind of a positive tipping point towards believing that the economy and the system can work for you. And that's why neighborhood strategies, as Raj Chetty identified, are really important.
And that was Dan Porterfield of the Aspen Institute. And David Weston joins us now on set, sitting to my left. And David, such an interesting conversation. And it feels like the benefits of community college are well known, but interesting to hear Dan's comments that when it comes to penetration with middle income students, there's still work to be done.
Particularly in the higher, more elite universities. And let me take a step back here, why we talked about this at all. We try to address questions for investors. And one of the issues for investors is where's the next generation of workers going to come from? And are they going to be up to the job? And this has been a land of opportunity, but I'll give you one statistic out of David Leonhardt's book, Ours Was a Shining Future. People born in the 1940s had a 90% chance of making more than their parents do. Today, it's 50-50. It's gone down that badly. It's 50% chance they'll make less than their parents did. And the question is, what do we do about that to maintain the American, I'll call it, economic miracle?
What's the investment challenge for community colleges? Because you've been exploring this challenge across spectrums, and even the most elite universities in this country have an investment challenge, in terms of bringing money in the door. What does that look like for community colleges?
Well, one thing is some people, like Larry Summers, say there should be more money put aside for this as we are in a presidential election year. We don't hear very much about that, but there may be an investment in education, specifically in community colleges. But I'll say from my personal experience, I've got a charity that I run up in Yonkers with public school students. Part of the investment is actually before you get to the community colleges, because too much community college time is spent remedial work trying to fix the educations kid didn't get in junior high school and high school.
First of all, congratulations on the new show. I watched it, was so happy with the new format. What do you have planned for this week? Is it too early to tell? Is it going to be a surprise, or?
No, it's not a surprise at all. Not at all, actually. We've got a two-parter, actually, on Pittsburgh and PNC, the big regional bank, and we went out and talked with Bill Demchak and talked to some of his clients. And the story of Pittsburgh is a fascinating one. We also talked to Art Rooney, from the Rooney family that started the Pittsburgh Steelers, the original NFL. Talked about Pittsburgh. It's a very extraordinary community because it was really go-go during the Steel days, as you know, and they built up big fortunes in a big city, and then it all went away, but they still have foundations, and so they invest a lot in their local programs.
All right, well, a lot to look forward to there. Of course, that is our own David Weston, and you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
Let's get to the trading diary, what you need to be watching. We get plenty of Fed speak through the week, including Neil Kashkari today. Tomorrow we get consumer confidence data, so we'll be watching that closely, followed by U.S. jobless claims, durable goods, and revised GDP on Thursday. Then Fed Chair Jerome Powell gives pre-recorded remarks to the 10th annual U.S. Treasury Market Conference. And we round out the week with PCE and UMich consumer sentiment on Friday. So a lot of consumer sentiment data and a lot of inflation data.
Yeah, and we'll see, of course, how that plays into the story in the markets right now, because we're building on gains with the S&P 500 currently up about 0.3%. We are at all-time highs when it comes to that closing basis, so we'll see if this sticks through 4 p.m. Big tech, too, joining the party. The NASDAQ 100 currently up about 0.4%. Even though you have a little bit of a sell-off in the bond market right now, you can see 10-year yields currently up 4 basis points or so. And guys, I got to wonder, what is the next catalyst? Is it just Fed speak? Is it listening to those FOMC members tell us about how they're worried about the labor market? Or what are we going to be trading off of?
I'm interested in that consumer data, as you've been talking about, because you have to wonder not only how it moves the bond market, but also how it moves the equity market. If you have to worry more about those consumer names, you think about FedEx last week alone. You think about the mixed read we have already gotten from the different restaurant brands and consumer brands out there. Let's see if it moves the needle.
When you were on vacation, FedEx came out with a profit warning.
Yeah.
And that was not good, right?
I did not catch that, I have to say. I did catch that the Fed cut interest rates in all-time highs, but...
Yeah, and so to me, this is the question. Does that really spur more euphoria in consumption?
Not if you're worried about growth.
Yeah, absolutely not. All right. Coming up on tomorrow's show?
Jeff Thomas, NASDAQ Chief Revenue Officer. This is Bloomberg.